Once again, welcome to Both Study Center, and today we are going to look at elements of financial statements. Of course, when you talk about financial statements, under financial statements we have income statement, we have financial position, we have changes in equity, but specifically today we want to know those things that we find in those financial statements. So we are going to start. Now we are starting with the first one. It is called income. When you talk about income, it is something you receive in monetary form that comes into your business, which is not part of your sales or what you sell. For example, when you are selling cars and maybe you have received some money from government, just put in your business or what, that money received, you don't record it as revenue or sales. No, you record it as grant received, because that money you have received it from somewhere, so you are going to use it in your business. It means it is going to increase your income. It is going to increase your income. So we have said one, we have government grant. When you receive that government grant, you put it back in your business and your business is going to increase. But remember, it is coming from outside the business that you operate. Then we have rent received. When you talk about received, maybe you own a business, but out of that business you also have a side hustle, and under that side hustle you have your apartments, you have your maybe land, you have what, and you have tenants who comes maybe and use your properties, your land, and after some time, maybe monthly, maybe year, like each year they give you some common. That means that rent you are receiving or something you're receiving from your tenants, it will increase your assets. In short, when you talk about income, it comes in when your assets are increasing but your liabilities are reducing or decrease. You increase assets, reduce liability. So we are going to a third one, the third income. The other income, we have commission received. This one comes in when you sell something. You can sell something, maybe you have sold too much, or you have made like a mega sale, and maybe someone has given you a commission. These are common, maybe in companies. You are trading, and out of that you have made like a lot of sales, and they have given you some money. That is a commission. After sales, commission received. Then also we have discount received, but this one, it comes on purchases. Maybe you have bought things in large quantities and they have given you some discount. So also this one will come and record it under discount, under income, because it's not part. Yes, it is a part of business, maybe of purchasing what, but remember, your assets has increased because the money you are supposed to buy those materials or your stock or your inventory has remained in the business. So that is our first elements of financial statements. Now we are going to second one. After income, today we are going to look at sales. Yes, we are looking at sales stroke. We have sales, or revenue. Ladies and gentlemen, when you talk about sales, or revenue, what comes into your mind? Here, sales. It is amount of money received from sales of goods or services. When you talk about sales, in short, sales comes in or revenue comes in after offering some service or after selling your product. The amount of money you receive, we call it revenue from sale. You have sold your property, like what you're dealing. For example, when you are dealing in cars, when you sell a car, it means the amount of money you receive from that car. It is a sale. It is a revenue. Then, when you are dealing maybe in agricultural products, and you have sold some item, to mean that amount that you receive, they are sales. Also, maybe, but here for sales or revenue, it is somehow different from selling. Maybe, for example, when you have land, and you are not dealing in selling and buying land, it means when you sell your land and get money and put it back in your business, that one we are considering it as income, because it's not coming from things that you have in your stock. In short, sales or revenue concerned with the items that you deal in to get money. Then we also have the sales. We are going to look at expenses. When you talk about expenses, these are costs incurred while operating your business. Yeah, when you have your business, can be having a business of selling shoes, can be having a business of buying and selling land, can be having a lot. But remember, in that process of operating a business, you incur some costs. And while you're incurring those costs, remember you are incurring those costs in order to sell something or to operate your business. And under those expenses, also they are categorized, because you can't bring something to this one. No, we have categorized them differently. And the first expenses, remember we are under expense. The first expense we have distribution expenses. When you talk about distribution expenses, these are expenses incurred while you're selling a product. Yeah, when you are selling a product, for example, you are dealing in cars, but remember that process, you bring some mechanic to repair some things. You need a space to park your cars. You need to pay URA. You need to do what? So under distribution expenses, we shall specifically mention things that lie under distribution. That means when you give customer a discount, it means it is your expense. Your personal, you are reducing your profit on what you are going to get on a car. It means you will be having, like, giving out something to customer on a low cost. It means here we have discount received. Discount received is under distribution expenses, because you are giving a customer a product at a low price compared to what you have been selling at it. Then another one we have, not this discount allowed. Yeah, you allow customers to buy your product sell a product at a low price compared to what you have been selling. Then you have transport. We have transport. It is called transport costs. Or we have carriage on sales. When you talk about carriage on sales or transport costs, these are costs that you incurred while taking a product or what you have sold to customer. For example, maybe you are dealing in bottle, dealing in paint, you are dealing in what, and you have promised a customer that when you buy products which are worth like maybe like 10 million, 20 million, what, why we deliver. That means while you're delivering those products, you are incurring your cost. You are using your money as a business to transfer those things to customers' destination. It means we are going to record it under distribution expenses as transport cost or carriage on sales, what you have used for people to carry them. Maybe also you can be having, you have your business, but whenever a customer comes and maybe buy something, you have someone you can say maybe help this customer take this product to his car, to his destination, what, and you give that person who's going to carry those things some money or some car allowance. It means it is coded under carriage on sales. Then also we have packaging costs. When you talk about packaging costs, this comes in when you are packing things for customer. For example, someone comes and buy large quantities, and remember sometimes there are some areas where you need to first buy those packaging materials. You are buying polythene, you are buying bags, you are buying what to pack in customers' items or things. To mean the money you have used to buy those polythene bags, or the money you have used to that anything that you are going to use to pack customers' items or things that customers bought. It means you are using your money, and that one we are going to put it under distribution expenses. Then we have sales and marketing costs. When you talk about sales and marketing costs, this one comes in when sometimes it comes in when a product is new and you want people to know your product, you want people to be aware of what you are selling. That means you will hire some people. You hire your energetic people to go and maybe distributing, like they'll be moving maybe shop to shop, doing advertising, telling them, you see this one new product, it is called this and this, it is used like this and this, everything. But remember the amount of money you are paying those guys who are marketing your product. It is under distribution expenses because you are making people like to know about your product. Also we have advertising. These days it is a digital. You need your product to be known, maybe on TikTok, you put on televisions, you put on radio, so that amount of money specifically for you are targeting what? More customers, sell more goods. It means also that one is also under distribution expenses. In short, distribution expenses for it is aiming on selling of product, offering more services. Then also after distribution expenses, we have another form of expense, which is administration expenses. It's called administration expenses or costs. These costs, for them, they involve costs involved in running of a business. running and operation and management of the business. Here we are looking at costs that are involved in administration costs, operation costs, the one you use like a daily, not specifying whether it is for distribution or it is for what. And here one of them can be depreciation. When you talk about depreciation, this one comes in when maybe you have your distribution vehicle, your what, and that distribution vehicle, it has depreciated, it has lost value, it has what, we shall come and record it under administration costs. Then also we have salary. We have salary and wages. Maybe a business is big, you have people who work for you, you will pay them. Even yourself, you will pay yourself. That means you are using salary. You are paying people. It means that one is under distribution costs. Yes, there can be in business, operating of a business. Also, we have professional fees. Yes, you have your lawyers, you have your accountants, you have your external auditors. All of them, they need money, they need to be paid. So when you pay those people, we record it under administration costs, because it is involving operation management of business. We have rent, where you are operating, it's not your building, and maybe after you pay that rent. So we have rent. That rent is administration, because rent is the amount of money you pay to someone, the owner of the building where you are operating business from. We have insurance. Your business need to be insured, because anytime a fire can come in and steal your things. It means you need something that can come up and recover your business. We have utilities. We have also amount of money that you use maybe to purchase fixed assets or non-current assets. So here we have purchase of a current asset. Purchase, you want a vehicle, you want a land, you want what. When you buy that thing, it is an expense, because it is not involved in your business operation. Yes, that means it is a purchase. You can say purchase of non-current, purchase of non-current assets. You bought your land, you bought your vehicle, you bought whatever, as long as it is any current assets, that one will record it under administration expenses. So you are using business money to buy your things. So those are some of the administration costs we have, and distribution costs. Yes, there are many, but here, as long as you know what administration costs mean, when you know distribution costs, you can get what you want, or you can add on. There are so many, and different books, different people have different things. As long as you know administration cost, the meaning, you know distribution cost, you know expenses, you know what I know. So after these ones, we have after administration expenses, we are going to other elements of financial position, other elements of financial statements. But specifically now we are going to look at those that we find in financial position. The first ones, these three: revenue, income, sales, expenses, and distribution costs. Those are specifically for income statements. But now we are going to look at the one for financial position. or the ones for income statement. And we are looking at the first one. We are going to start with, we are starting with assets. We are starting with assets. When you talk about assets are resources controlled by enterprises or enterprise as a result of past events, and from which the future economic benefits are expected to flow to enterprise. They are expected to generate a future benefit. Yeah. When you talk about assets, these are things that anytime I will receive money coming into the business. Whether it can be non-current, it can be current, but you can be assured anytime you are going to receive what? Assets. And when you check the definition of assets, the first one talks about control. We need to know, you have control. They have said it is resources controlled by enterprise. It means your enterprise or your farm or your business, it has control on that item. Maybe you can say that is my land. When I sell my land, I will receive money and it will come into business. And when you talk about control, here is defined as ability to obtain the economic benefit from an asset through we have sale. Maybe your assets, you have a control on your asset. That means when you sell that asset, you will receive some money. Second, to use it, maybe you are using your asset. For example, you can be having a motor vehicle that helps you transport bakery products. That means you are using your asset to generate income or to generate economic benefits. Yeah, you are. So we have said assets. A business must have control over the asset. It means when you sell that product or when you dispose that product, when you dispose that asset, you receive some money. When you use that product, you receive some money. It can be in the long run or short period of time. Then also, this one was under control. Then you have past events. When you talk about past event, assets arises from past events. It means you must be having a land that you bought it some time back. That means that land, if you have it, maybe it was inherited, maybe it was bought some time back. Now you are expecting anytime if you sell it, you will get what? You get back the money. You get back something like money or what? In short, assets. You must be having a control over it, and also it must be coming from past events. To have control on something, you must own it. You have it, you are using it. You know, anytime if you want to some money you can sell it. So it means assets arises from assets arises from past events or what happened before. So that is our past event under assets. First I have said control, you must be having control of it. Hey, yeah, you have a bit to obtain that economic benefit to an asset. You have control. You have whatever it needed to show that this is your land. You have logbook to show that this is your vehicle, so that when time comes for selling it or for using it for other things, maybe in order to increase on inflow or daily or what, you must use it really. But remember that thing, it was obtained before. That's why I said assets, you must be having control over it. It must be past event, and finally it must be having a future economic benefits. Yeah, if you have that land, anytime you can sell it and get money. But we have said that land, it was got from previous things. You bought it some time back, maybe you have been doing something on that land, maybe you are doing what it means. Anytime when you sell that land, you receive some money. So that is our assets, where we have said there are resources controlled by enterprise. Yeah, remember now we are talking about business. It is controlled by enterprise as a result of past events. Controlled by enterprise as a result of past events, and from which future economic benefits are expected to follow in business. So that is asset. You have control over it. It is a past event, and you are expecting something in the future. Also you are expecting future economic benefits. We benefit from it. So under assets, we have first one, they are called non-current assets. Here we have non-current assets. Non-current, what I mean by current assets? These are assets that lasts for more than a year. These are assets. When you talk about non-current assets, for them they last more than a year. It means when you buy your motor vehicle, and maybe you will be using it maybe after 5 years, after doing what, you will sell it. It means it will take some time for you to be using that thing, that assets, that fitting and what, that machinery. You'll be using it more than a year. And under non-current assets, we have land. Of course, you'll buy land, use it, have control of it, and maybe sometime, maybe after 2 years, after what, when you sell it, you get some money. It means our land. It's very hard to find someone having a land and maybe she's going to sell it within a year. Maybe if that business deals in selling and buying land, that one we don't consider. We don't put land here under non-current assets. That land, it just goes to inventory. But here we are considering, we are assuming that our business is dealing in other products. That's why we are bringing land under non-current assets. Then also we have motor vehicle. Maybe your business is growing and it needs deliveries, it needs transporting goods, commerce goods. You go and buy your vehicle. Buy your vehicle, you'll be using it year after year until you decide to sell it or to dispose of. Then also we have, remember we are talking about non-current assets, and we have said those are assets that lasts more than a year or that takes more than a year within a business. And also we have investments. When you talk about investments, for example, you may find that someone sells motorcycles, but remember, during selling motor vehicles, he or she decide to open up spare parts for motorcycles. It means that car spare parts shop is his investments. He has a motor vehicle, he deals in motorcycles, but he has also some other shop for spare parts. You are selling maybe your motorcycles or your cars, but also you have agribusiness. You cultivate and harvest something. You are dealing in agriculture. It means what you are doing, for example, you have your coffee, you have your cabbage, you have what. So that is a side hustle, it is like an investment. Anytime you go and sell your coffee and receive that money, also that one is under non-current asset because it takes or it lasts more than a year. Then also we have equipment, we have machinery. When you have, for example, factory, you have your machines, you have equipment, you have what you use to make your product. To mean that thing to last more than a year. Then after that one we have intangible assets. When you talk about intangible assets, these are assets that are not seen, touched in a business. You can't see them, but someone say this is our asset. Here, for example, the first one, and we have goodwill. When you talk about goodwill, it is a price. Goodwill is a price higher than the fair value of its net sales. It is a price higher than fair value of its net sales. That is goodwill. Here, example of goodwill, I can say maybe, for example, someone has a shop, but that shop, maybe a person comes and say, for me to leave this place, you need first pay me something like 2 million before even counting the amount of quantum or what, or when I want to go with his goods or what. You come, you pay that million, maybe for booking. Sometimes people they can say it is booking money, not rent, booking. You are paying some money, maybe just to convince the other person to leave or what, because of the place. The place has goodwill. Maybe it is a good located place, maybe it is a strategically located place where you can go and make some good money. So that is goodwill. For it is not attached to anything like what you sell or rent. No, for it is given out, maybe according to the place of the business, and it is non-refundable. Then we have brand name. When you talk about brand name, you see this one is common in those big names. Maybe someone having, for example, you can talk about Shell. Shell, it is a brand name. It is a name called Shell. If you want maybe to use that name, maybe you want to open up some capital station, you just go and talk with those guys of Shell and follow their rules and regulations and use it. Yeah, and people will be coming to buy you from your petrol station knowing that they are getting good quality. Yeah, maybe about brand name, maybe you can say someone comes there and say I work with this company, this and this and this. Since that company is already known, people are giving you respect. People are giving you access to other things. So a brand name for it is hard. You can hear Shell, Total, what, KFC, but you can't see it, you can't touch it. Yeah. So those are some of intangible assets, and they also last more than a year. Then non-current assets. We have current assets. When you talk about current assets, the assets that last less than a year. For them, you are expecting money anytime. Anytime you receive money, anytime receive money. So those are current assets. When you talk about current assets, this one is commonly within day-to-day running of the business. Yeah, because when you talk about current assets, here you know anytime during the day, during what, anytime you receive that money. And one of those things under current assets, we have inventory. When you talk about inventory, some call it inventory, others call it stock. Inventory, these are goods or products that you are dealing in. For example, when you have a real estate and you are dealing in buying and selling land, it means your inventory is land. When you are buying and selling houses, your houses are inventory. When you are buying and selling maybe coffee, your coffee, it is your inventory. In short, inventory, it is that item or goods that a business is dealing in. Yeah, that is inventory. The item or the services that you are offering. Maybe when you are in teaching institution, let us assume in teaching institutions, for them, their inventory is teaching, because they provide that service of teaching and get money. Then next, we have trade receivables. When you talk about trade receivables, this comes in when a business sells inventory or its goods on credit. Yeah, some book or some other, they call them debtors. You sold your goods, but anytime you will expect money. You know anytime they are going to pay you, but paying you after delivering those things or after selling your product to that person, that means anytime if that person pays you, it will be current assets. It is the money you have received, the money within less than a year. So those are trade receivables, amount of money you are expected to receive from someone you sold goods to. Then we have We have bank. When you talk about bank, this is like the money you have, but it is what it is kept in the bank. So anytime you want it, you just go and withdraw. We have cash. This one, you have it in your pocket or in your drawer. Anytime you want to buy maybe something, you just go and pick it from bank. And there are more. So other assets. And now we are going to look at liabilities. What do you mean by liabilities? In simple terms, liabilities, these are like obligation or something that anytime I'm going to pay money, but that thing it resulted from a previous or past event or what you did previously. For example, when you get a loan today, just know anytime to come you are going to pay that loan. That means this loan, that time when that time comes, it means this loan will be a previous item, it will be a previous event. So when you talk about liabilities, a liability, they have said a liability is a present obligation from past events, settlement of which will result in outflow of economic benefits from entity. Liability, it comes in when you talk about liability or liabilities for it, it is against a business. Maybe you did something previously, you got a loan, you purchased some things and did not pay, or you purchased on credit. It means anytime you repay, that is a liability. Anytime you go and pay. Yeah. So under this definition, where we will say it is a present obligation from past events, the settlement of which will result in an outflow of income benefits from the entity. And here we have some key terms that we have in our definition. First one, have obligation to pay. As we have said, you have used services or you have bought things but on credit. That means anytime you will pay that thing, you will clear. When you clear, that is your obligation. You have a right, you have a responsibility to pay something that you used before. As we have said, it can be a loan, it can be goods you bought on credit, it can be other things. Then also we are still under things that are in liability, definition of liability. We have past. Also, this one has a past event. When you talk about a past event, it means the past event or the previous thing. It is something you used previously. It can, maybe you got a loan, maybe you purchased goods on credit. It is also considered as liabilities. We have said liabilities, they are present obligation. Therefore, today you want to clear them today, but they resulted from past event, and for their settlement or to clear them, you must pay using your sources. So that is some things about liabilities. We are still on definition, where we have said it is present obligation from past events, the settlement of which will result in an outflow of economic benefits, or to be outflow, or you are going to pay using business money. And also under liabilities, we have non-current and current liabilities. So now we are going to start with current. We are going to start with non-current liabilities. Also, as we have said, like on assets, these liabilities, non-current liabilities, they are liabilities that take more than a year. In short, these are liabilities that you repay after a year. When you talk about paying after a year, We can be having long-term borrowing. Long-term borrowing, it means you went and borrowed some money and you said, I'll pay this money in 2 years. Yeah, that means you look for that money after 2 years, you will clear. Like as you have seen from like our definition of liabilities, it is a present obligation. Yeah, and you have it right now, you need to clear, you are going to clear, but the one you are going to clear, that thing, it resulted from a previous or a past event, the event that you did previously, not current, not in current period. So we have long-term borrowing, we have deferred tax. When you talk about deferred tax, this one rises between tax expenses recorded in the financial statement and actual taxes payable to authorities. Of course, this one rises when, for example, you paid some tax, but during the accounting period or what, they discovered that the tax you paid, it is less, it is more compared to actual taxes or what you need to pay. That means the subtraction, when you get that deferred tax or the tax you recorded and you raise the actual tax, that tax you need to pay, the tax you need to pay. Yes, no, this one comes in when you pay taxes, and in paying tax, like for you comes and records maybe 200 million as a tax. That's what you have recorded. But when you check, you are supposed maybe to pay taxes of 3 million or 4 million. It means that difference to go under deferred tax, because you still have obligation of that difference of 2 million or 1 million to pay. Remember, for you have recorded or you have paid 2 million and the balance of 1 million to make it 3 million, because you are supposed to pay like maybe, for example, 3 million, but you have paid 4 million. It means that difference of 1 million to go under deferred tax. For it, you will pay it in another period. That's why I said it is obligation to pay. You will pay it maybe next accounting period, but remember, this tax is coming from previous accounting period because you paid less. Yeah, those are non-current liabilities, as long as anything that you know you will pay. But concerning with the business, can be loan, can be deferred tax, can be what, but you know anytime you pay them after they just go under non-current liabilities. Then we have current liabilities. When you talk about current liabilities, these are liabilities that you will clear within less than a year. It means before the year ends or any time during the operation, you will clear those things during the operation. Anytime, it can be a week, it can be a month, just you clear those things. And current liabilities, we have trade payables. When you talk about trade payables, these are things, for example, you went to your supplier and bought things on credit. When you buy things on credit, we shall record them as trade payables. Yeah, you went and picked things, but you have not paid. That means anytime you are going to pay or you are going to clear using business money, yeah, you'll be using business money. Those are trade payables. Goods that you bought on credit, they're the ones we put under trade payables. Yeah. Then we have short-term borrowing. Remember, I have said these current assets, current liabilities, they are liabilities that are cleared, or the business is going to clear within a short period of time. That means you can get a loan of 5. Hey, I want a loan of 5 months. I want a loan of 6 months. That means that loan is under current assets, because after that 6 months, remember we have said this one is less than a year. You pay it or you clear it within a less than a year. When you get that borrowing, you can't pay after that period of 6 months or 4 months. Then also we have current. We have current tax. When you talk about current, these are the tax that you pay in each period. Remember, the period can be overpaying it. So that's when the deferred comes in. But here under current tax, most people call it operation tax. The one you the one you repay this period of time right now. That is current tax. The one you are supposed to pay. It's a mandatory to pay tax. That means each accounting period, the amount of tax you pay, or the amount of tax you are supposed to pay, you come and record it where? Under current tax. The one you have paid. Then we have bank overdraft. This one comes in when you overdraw from your bank. For example, you have maybe like 20 million, but for you, when you have reached, you have withdrawn 22 million. Remember, this is a business account. When you reach there and you withdraw excess, it will be recorded as bank overdraft. So those are current liabilities. The liabilities that takes on the one you clear before a year ends. Then non-current assets liability, we have said that the ones you clear or the one you pay after a period of 1 year. Then we also have owner's equity. We have owner's equity. When owner's equity, what do you mean by owner's equity? What do you mean by owner's equity? This is amount of money. You can say amount of money, you can say residue, you can say whatever, as long as you could, as long as it is in monetary term. It is amount of money left after deducting all liabilities of the entity from assets. In short, owner's equity, it is amount left after deducting liabilities from what? Deducting liabilities from. It means if you have your assets worth like 20 million and you have your liabilities of 10 million, no, like 11 million, it means that 9 million will be recorded an owner's equity. So that is our owner's equity. For it is good after deducting liabilities from total assets. And remember, under owner's equity we We have share capital. What do you mean by share capital? When you talk about share capital, so our share capital, when you share capital, it is amount of money invested in business. Remember, we are under owners equity, so this one is amount of money invested in business. For example, maybe someone like at start of business, someone brings in a motor vehicle worth like 20 million in a business. That means you come and say the owner has brought a motor vehicle worth 10 million, and that amount or that motor vehicle, it will be considered as capital, as a startup capital. Maybe that vehicle is used for transport, is used for to earn money. Yeah, we shall say this person has brought a capital 10 million as a vehicle. Maybe you can say someone started a business worth 20 million. That amount that you started with is a share capital, what you have in a business or what you share in a business. So in short, share capital is amount of money invested in a business. Yeah, amount of money invested in a business. Then we have retained earnings. When we talk about retained earnings are profits that a company has reinvested in a business instead of distributing to shareholder. In short, this retained earnings comes in that amount of money. Maybe it is a net profit after subtracting all expenses and after doing everything, and that amount of money that remained a net profit, that amount of money, it is the one, that amount of money that you invested it in short, when you get that net profit, instead of distributing them to share capital, when you decide to reinvest in a business, it will be considered as a retained earnings. In short, retained earnings, it is a profit reinvested in. It is a profit reinvested in business. Yeah, it is a profit reinvested in business. Then also we have net profit. When you talk about net profit, it is amount of money. It is amount of money left when you get total income or total revenue, and you subtract expenses. It is amount of money left from amount of money left after deducting total expenses from total revenue or total revenue or total income. In short, this is amount of money that remains when you get what you sell, your sales, your income received, then when you subtract expenses, what you have incurred while doing business, that amount of money, it is the one we call net profit. It can be net profit or net loss. So specifically, those are things that some of the things that we find ni financial statements. Yes, there are more, but those are somehow the one I have tried to get. So, and we have more. We have more because when you check in different books, when you check in the different items, different articles, you will find there. So what you need is a matter of knowing their definition, what they mean. You can go and get more. Yeah. So those are elements of financial statements. They can be less. The one I have given you, it's not the form. Okay, thank you.